If I had to explain what's happening to your money today from scratch, knowing what I know about the inflation flare-up, the oil shock, the debt pile, and the digital money push now sitting in the background, I would do it completely differently. Most people think what's happening is just a bad news cycle, or just another war headline, or just one more annoying jump at the gas pump. But that's not really what this is. This is a change in the environment your money is living in, and when the environment changes, your strategy has to change with it. Today is Sunday, April 12th in New York, and I want you to comment the day and date you're watching this from. And if you value the way I break this stuff down, support the channel by subscribing and commenting John A.G. Best. It helps more than you think. Because here's the real issue. They're not exactly lying to you in one clean, obvious sentence. It's actually more subtle than that. They tell you one piece here, another piece there, and then they leave you to connect the dots on your own. You hear about inflation. You hear about conflict. You hear about oil. You hear about debt. You hear about digital payments. But almost nobody steps back and says, hang on a second, these are not separate stories. These are pieces of the same machine. And that machine is chewing on purchasing power whether people realize it or not. So by the end of this, you're going to understand why your money can feel fine on paper while getting weaker in real life. And more importantly, we're going to walk through how I would think about protecting myself in an environment like this. Not in a fantasy world, not in some perfect textbook model. In this world, right now, with all the noise, all the politics, all the spin, and all the very real risks that are starting to stack on top of each other. Now, before we go any further, I want to be clear. I'm not your financial advisor. I'm not telling you what to buy on Monday morning. I'm giving you a framework. That's it. A framework you can test, challenge, and use as part of your own research. Because the people who wait for perfect certainty usually don't get rewarded. They usually get surprise instead. So let's start with the part you already feel in your wallet, and that's inflation. Based on recently published numbers, consumer inflation in the United States moved from the mid-2s to the low 3s in just 1 month, while the energy component jumped into the low double digits and gasoline posted one of the ugliest monthly moves in decades. That matters because when energy starts doing cannonballs into the pool, it doesn't stay in one little corner of the economy. The splash goes everywhere. And this is where people miss the setup. Inflation did not suddenly appear out of nowhere because one headline got louder. Price pressure was already sticky. Shelter was still moving. Food was still moving. Services were still acting stubborn. Then you layer an energy shock on top of that, and now the problem can stop feeling temporary and start feeling atmospheric. That's when people get into trouble, because they keep waiting for prices to behave like they used to, while the entire cost structure underneath them is being rearranged. Now let's talk about oil, because this is where the story gets a lot more serious than the average cable segment makes it sound. From recent energy updates, the Strait of Hormuz has effectively been shut to normal shipping since late February after military action in the region, and that strait carries nearly 1/5 of global oil supply. Brent averaged a little above $100 in March and briefly pushed into the high 120s in early April. That is not background noise. That is the bloodstream of the modern economy getting squeezed. And when the bloodstream gets squeezed, you don't just pay more at the pump. Trucking gets hit. Airlines get hit. Chemicals get hit. Manufacturing gets hit. Fertilizer gets hit. Shipping gets hit. Groceries get hit. Then landlords, retailers, and service businesses start trying to pass those higher costs forward, and suddenly the everyday bill for normal life starts acting like it's got its own revenge agenda. That's how inflation spreads, not in one dramatic explosion, more like a stain moving through the fabric. First energy, then transport, then input costs, then shelves, then rent, then insurance, then wages try to catch up, then expectations move. And once expectations move, the job of containing inflation gets harder, not easier, because now people begin setting prices and negotiating pay based on what they think is coming next, not what happened last month. And that is why this is bigger than one conflict. Official international outlooks over the last few weeks have warned that the Middle East conflict can keep transport and fuel costs elevated, disrupt key shipping routes, weaken trade, and push inflation pressure back up even while growth softens. In other words, you can get the ugly combo: slower momentum, shakier trade, and higher prices at the same time. That's not a healthy economy. That's the sort of setup that makes investors, households, and policymakers all miserable for different reasons. And yes, that ugly combo has a name. People call it stagflation. It's one of those words everybody suddenly remembers when the world stops playing nice. Growth cools off, costs keep rising, confidence gets weird, markets turn jumpy, consumers pull back, businesses get cautious, central banks have fewer clean choices, and everyone starts discovering that the old easy answers don't work so well in a mess like that. Now, let me say something important here, because I don't want to oversell the drama. A lot of people talk about stagflation like it's guaranteed. It's not guaranteed, Economies are more dynamic than that. Technology is still pushing productivity in some sectors. Corporate balance sheets are not universally weak, and there are still parts of the global economy showing resilience. But resilience does not cancel risk. It just means the landing path is still being fought over. The bigger background issue, though, the one that quietly hangs over all of this, is debt. According to daily Treasury figures and broader federal debt data, total United States debt is now sitting just shy of $40 trillion. That is not a rounding error. That is not a number you solve with good intentions and a stronger speech. It is a giant permanent feature of the landscape now, and the longer it sits there, the more policy gets shaped around managing it, rather than eliminating it. And this is where a lot of regular people get uncomfortable because they sense something true but can't quite articulate it. They feel like the system has a strange relationship with inflation. On the one hand, officials say they want price stability. Of course they do. On the other hand, a world with slightly hotter nominal growth, slightly easier money, and slightly weaker currency math can make an oversized debt load feel less suffocating in real terms. Not gone, just less crushing. Now, am I saying some secret room full of people sat down and decided to rob savers? No. I'm not doing the cartoon villain version of this. Real policy is usually messier than that. Incentives matter more than conspiracies most of the time. Governments carry debt. Economies hate recessions. Voters hate austerity. Markets love liquidity. So the path of least resistance often ends up looking a lot like tolerated inflation, delayed discipline, and constant pressure to keep the machine moving. And who gets pinched in that environment? The person who thinks cash is safety forever. Cash has a role. I'm not saying become some unhinged all-in asset maniac who can't pay a repair bill. You need liquidity. You need reserves. You need enough dry powder to sleep at night. But there is a huge difference between an emergency cushion and a lifestyle built around idle money slowly shrinking while you call it prudence. Those are not the same thing. One is risk management, the other is hidden surrender. This is why the usual advice a lot of people grew up hearing needs more context now. Save, be conservative, leave it in the bank, wait for clarity? Maybe. For a short season, maybe. But if inflation runs above what your cash is earning, then every extra month of oversized cash balances is a month where your purchasing power is doing the opposite of compounding. It's quietly melting. Now let's go one layer deeper, because inflation and debt would already be enough for one video. But there's another development sitting in the background that people dismiss until it suddenly doesn't feel theoretical anymore. And that's the future of digital state money. From current central bank and policy tracking, well over 100 countries and currency areas are exploring some form of central bank digital currency. And the Federal Reserve still describes a retail CBDC in theory as a direct liability of the central bank and the safest digital asset for the public from a credit and liquidity standpoint. That means this conversation is not fringe anymore. It is already inside institutions. Now, I want to be careful here because this is where a lot of people either get hysterical or get lazy. They go all the way to, this is definitely tomorrow's nightmare, or all the way to, this is boring and will never matter. I think both reactions are too simplistic. Here's the counterpoint that almost nobody on either side wants to admit. Some central banks have explicitly said they do not want programmable retail money that tells people what they can buy or when their money expires. European officials have repeatedly said a digital euro, if it ever launches, would complement cash rather than replace it and would not be programmable money in the voucher sense. So, no, it is not intellectually honest to pretend every single CBDC proposal automatically equals an expiring coupon with a government mood ring attached to it. But that does not mean there is no risk. Because the issue is not only what the first version is, the issue is what becomes possible once the rails exist. Once money is fully digital at the sovereign level, with direct settlement, richer data, faster policy transmission, and cleaner control features, the temptation to expand what can be monitored, encouraged, nudged, or restricted does not exactly disappear. Crisis is the accelerator of powers. It always has been. Tools built for convenience can drift toward control when the political weather changes. That's just history, not paranoia. History. So when I look at inflation, debt, geopolitical stress, and the digitalization of money all at the same time, I don't see random headlines anymore. I see a tightening operating system. Not total control, not instant dystopia, but a tightening operating system. One where mistakes get punished faster, optionality matters more, and people who never learned to think in real assets suddenly realize the measuring stick they trusted was weaker than they thought. So, what do you do with that? Well, the first thing is you stop thinking like your only job is to accumulate dollars. Your real job is to preserve and grow purchasing power. Those are not always the same thing. A bigger account balance means nothing if the things you need to buy are outrunning it. That's not wealth, that's cosmetic progress. Which brings me to the first rule I would use in an environment like this. Own productive assets. I'm talking about businesses, or broad baskets of businesses, that can live in an inflationary world better than you can with a pile of idle cash. Not every company, not every hype story. I'm talking about companies with margins, real demand, balance sheet strength, and ideally some ability to raise prices without getting laughed out of the room by their customers. In messy inflation, pricing power is not a luxury. It's armor. And based on the latest public outlooks, global growth has not fallen off a cliff. It's still expected to keep moving, just with larger downside risks from geopolitics and fragmentation. That matters because it tells you this isn't only a doom story. There will still be winners. There will still be businesses compounding, innovating, and passing through costs. The question is whether you own some of that or whether you're just watching it happen from the sidelines. Now, second, and this one should be obvious after everything we just walked through, you think seriously about energy exposure. Not because energy is some magic bullet. And definitely not because every energy trade is smart. Some people hear oil shock and instantly turn into cowboys. That's not what I'm saying. I'm saying if an energy squeeze is one of the engines pushing costs higher across the system, then selectively owning businesses or funds that benefit from firmer energy pricing can act as a partial hedge against the damage happening elsewhere in your life. If oil is hurting your weekly budget, maybe some portion of your portfolio should at least know how to fight back. Third, reduce cash drag. Again, not eliminate cash. Reduce cash drag. Have your emergency fund, have your sleep at night money, have enough reserve for job uncertainty, house repairs, health surprises, whatever life decides to throw at you when your calendar is already full. But beyond that, be honest about what your money is doing. Is it waiting with purpose, or is it hiding with excuses? There is a big difference, because too much cash has this fake feeling of control. You look at it and think, well, at least it's not going down. But in real terms, if inflation is running hotter than the yield you're earning, it is going down. It's just doing it politely. That's why people underestimate it. There's no red candle, no terrifying chart, no breaking news banner, just less buying power for the same dollars a year later. That's a real loss, whether your app makes it look dramatic or not. Fourth, diversify beyond one political and economic lane. And I know, a lot of people don't like hearing that because home bias feels comfortable. You know the brands, you know the stories, you know the rules. But when trade tensions rise, supply chains get shakier, and countries start thinking more defensively, concentration risk becomes a bigger deal. You don't need to become some wandering macro tourist with money scattered across the planet like confetti. I'm not saying that. I'm saying a portfolio that only knows one system is more fragile than most people think. Broader international exposure, used intelligently, can give you different sector mixes, different currency exposure, and a little more breathing room if one region gets politically or economically jammed up. Not perfection, just less dependence on one single script playing out well. Fifth, own scarce things. This is where people start arguing with each other on the internet for 12 hours, but the principle is actually simple. When trust gets shaky and money gets softer, scarcity starts looking more attractive. Real estate in the right form can matter. Precious metals can matter. Certain digital assets can matter. Productive land can matter. Infrastructure can matter. The point is not that every scarce asset goes up every week. The point is that limited supply can be a useful trait in a world where currency units can be multiplied far more easily than real things can. Now, let me add nuance here, because nuance is what keeps people from doing stupid things. Scarcity alone is not enough. A rare bad asset is still a bad asset. Plenty of garbage is scarce. So don't hear me saying anything limited supply equals guaranteed winner. No. Utility matters, liquidity matters, custody matters, volatility matters. You still have to think. But I do like having some allocation to things that are nobody else's promise. That matters to me. And yes, that includes some physical ownership where it makes sense. Not because I think the whole digital system disappears next Tuesday. That's not the base case. I use digital systems every day. You do too. The world runs on them. But if the direction of money is toward more digitization, more centralization, more tracking, and faster policy plumbing, then I think there is common sense in not making every single ounce of your net worth dependent on a screen, a password, an intermediary, or a policy decision you don't control. Direct ownership has a psychological value too. It reminds you what wealth actually is. Now, I want to make this practical, because theory is useless if it never lands in behavior. If I were building my defense plan from scratch in this environment, I would start with an audit. Write down what I own. Write down what's cash, what's debt, what's productive, what's speculative, what's protected, what's exposed. Most people don't do this because they think they already know. They don't. They know the rough story, not the actual picture. Then I would decide how much liquidity I truly need, not how much makes me emotionally comfortable in the abstract. Those are different numbers. One is calculated, the other is fear dressed up as discipline. After that, I'd decide what percentage of new money gets deployed automatically into the kinds of assets I want more of. Because automation is underrated. It cuts out drama, it cuts out mood swings, it cuts out the constant temptation to wait for a cleaner entry that never quite arrives. A system beats a feeling over long stretches of time. Then I would review it regularly, but not obsessively. This is another place people sabotage themselves. They build a good plan, and then they poke at it every day like they're checking if planted seeds are working by digging them back up. Stop doing that. Good strategy needs air and time. And let me say one more thing, because it matters. If you're successful, share your success story in the comments so others can stay motivated. That stuff matters more than people think. Most people are not surrounded by healthy financial thinking in real life. They're surrounded by stress, silence, impulse, and noise. Sometimes seeing that somebody else actually changed their habits, built reserves, bought assets, stayed patient, and improved their life helps more than another motivational quote ever could. Now, what should you avoid? Well, first, avoid the idea that waiting in cash is always the responsible move. Sometimes waiting is wise. But waiting has a price, and in inflationary periods, that price can be higher than people realize. So don't romanticize hesitation. Second, avoid the urge to make every decision a political identity test. This stuff is bigger than party slogans. Oil doesn't care about your ideology. Debt math doesn't care about your favorite commentator. Purchasing power doesn't check your voting record before it disappears. Stay analytical. Third, avoid putting all your hope in one single miracle hedge. No one asset solves everything. Not stocks alone, not gold alone, not energy alone, not real estate alone, not digital assets alone. Each hedge covers a different weakness. The point is to build layers, not worship one answer. Fourth, avoid blind trust in systems you haven't thought through. Banks matter, markets matter, institutions matter, but trust should never be lazy. Understand what you own, where it sits, how liquid it is, what the counterparty is, and what assumptions you're making about access. That's not fear, that's adulthood. And fifth, avoid emotional whiplash. In periods like this, headlines can make you feel rich on Tuesday, doomed on Wednesday, and stupid on Thursday. That is not a signal. That is a tax on attention. If your framework is sound, you do not need to reinvent yourself every 48 hours. So let's connect all the dots one more time. Inflation reaccelerates. Energy jumps. A key oil choke point gets disrupted. Trade and shipping risks rise. Growth faces headwinds. Debt sits near record highs. Digital money development keeps advancing in the background, and ordinary people are told these are all separate conversations. They're not. They're connected by one central fact. Your money lives inside a system that is becoming more sensitive to geopolitics, more burdened by debt, more vulnerable to supply shocks, and more digitally managed than the one most people were taught to prepare for. That doesn't mean panic. It means wake up. It means the real question isn't whether things might get more expensive from here. The real question is whether you keep approaching your life with a savings-only mindset in a world that increasingly rewards ownership, adaptability, and understanding. Because people who understand the shift earlier usually have more options. They rebalance sooner. They reduce dumb risk sooner. They build positions sooner. They stop confusing passivity with safety sooner. And that can make a massive difference over time. I think that's what too many people miss. Wealth protection is not about predicting every headline correctly. It's about arranging your life so that when the headlines get uglier, you're not standing there financially naked, hoping somebody on television says something reassuring. You don't need to know everything. You do need to see the direction. And the direction to me is pretty clear. More volatility, more sensitivity to energy, more pressure from debt, more global fragmentation risk, more digitalization of money, and more need for ordinary people to take their own financial architecture seriously. That's the game. So build around that game. Own better assets, keep enough liquidity, reduce dead cash, diversify your exposures, own some scarcity, respect energy, understand the monetary rails, and stop waiting for a return to the old easy world before you start preparing, because that old world may not be coming back in the way people hope. And if you do that, you don't need perfect forecasts. You just need discipline, awareness, and the willingness to act before a crisis forces your hand. That's how I'd think about protecting wealth here. That's how I'd think about hedging the craziness. There are basically two ways people try to survive a weakening money environment. The first way is defensive delay. They hold more cash, postpone decisions, hope prices calm down, and tell themselves they'll move later when things feel safer. The second way is selective ownership. They still keep reserves, but they focus on owning things that can adjust, reprice, or hold scarcity, while the currency unit itself gets pushed around. I also want to say something about rates, because people hear inflation and immediately assume the solution is just higher rates fix everything. Sometimes higher rates do cool demand. Of course they can. But in a debt-heavy system, high rates also create their own stress fractures. They hit housing. They hit refinancing. They hit regional borrowers. They hit governments rolling debt. They hit small businesses that don't have giant fortress balance sheets. So policymakers are often trying to thread a needle while wearing oven mitts. It's not easy. That's why you get this strange stop-start feeling from policy cycles. Tighten, pause, talk tough, hint softer, ease a little, worry about growth, worry about inflation again. The message looks inconsistent because the constraints are inconsistent. They are trying to control prices without cracking the credit machine. Good luck with that. And that's also why I think people need to stop waiting for some perfectly clean macro backdrop before acting. Clean backdrops are usually obvious only in hindsight. In real time, you get mixed signals. That's normal. What matters is whether the broad incentives are changing in a direction that hurts cash and rewards ownership. Right now, I think they are. Now, on the asset side, let me sharpen this up a little more. For productive businesses, I like simple exposure first. Broad, low-cost ownership of strong companies is a beautiful thing because it lets you participate in earnings, innovation, and repricing without turning your life into a full-time prediction contest. Then, around that core, some people may want more focused exposure to sectors that tend to behave better in inflationary or resource-constrained periods. But the core matters most. Fancy toppings do not save a bad base. On real assets, I'm less interested in fantasy and more interested in staying power. Can it generate income, preserve utility, or remain desirable in a world where financing conditions are not always friendly? That's the question. Plenty of people bought real assets in the wrong place, at the wrong price, with the wrong structure, and learned the hard way that not all hard assets are hard to lose money on. So be thoughtful. On metals, I think people should understand the role before they buy. Metals are not there to entertain you every week. They are not there to make you feel like a genius on demand. They can sit there and bore you for stretches. Then suddenly everybody remembers why monetary history still respects them. That is usually how it goes. So if you own them, know why. Don't buy them on Tuesday and get offended by Friday because they didn't perform like a meme stock with espresso. On digital assets, same thing. There is a huge difference between understanding the case for a scarce digital bearer asset and blindly chasing every shiny coin with a dog on it and a broken website. I don't put those in the same universe. One conversation is about monetary alternatives and network adoption. The other is about people learning expensive lessons with extra speed. And on global diversification, I'm not saying your domestic market is doomed and the rest of the world is magically clean. Not at all. Every region has its issues. Europe has structural headaches. Parts of Asia are heavily exposed to energy imports and trade stress. Emerging markets can be volatile and politically uneven. I'm not selling a fairy tale. I'm talking about reducing single system dependence. Because fragmentation is not just a talking point anymore. When trade frictions rise and governments think more about resilience, security, and local control, capital can start behaving differently too. Supply chains get rerouted, costs shift, margins change. Old assumptions about efficiency give way to new assumptions about redundancy. That can create winners and losers in places people weren't paying attention to a year earlier. And here's something else. A lot of people think they need a massive amount of money before any of this matters. That's not true. Obviously, more capital gives you more flexibility? Sure. But the habit of thinking in purchasing power instead of paycheck alone can start much earlier than people assume. The person building a small but consistent ownership habit is often in a better long-run position than the person making more money, but leaving their financial architecture on autopilot for 10 years. The goal is not prediction. The goal is durable positioning now. And that's how I think about staying on the right side of a system that is changing faster than most people realize. Take what's useful, challenge what isn't, do your own homework, and make decisions with a clear head. This is for education, not advice. And the best outcome here is not that you copy me line for line, but that you leave this with a smarter framework than the one you walked in with.